Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Steve Wyett, chief investment strategist at BOK Financial, to discuss if we were, in fact, in a recession. Steve, it's great to see you as always. Welcome back to Trade Talks.
Hi, Jill. Thanks for having me back. Appreciate
you got it. And it's such a great question to ask today. We finally got Powell's comments out of the way, Jackson Hole. We got a number of inflation data out. So the question is, are we in a recession or not? And does it matter?
Well, I think that's the key point. Does it matter? And if we listen to what Jay Powell said today, I'm just going to say I don't think it matters. That's not what the Fed is going to pay attention to right now. He kept his comments very brief today. I think the point was he didn't want to muddy the water with trying to talk too much. He wanted to be very clear in what the Fed is trying to accomplish. They are focused on inflation. They think they still have work to do. They think the labor market is too hot. They want to see some improvement in the JOLTS open jobs data. They want to see the pressure on wages come down. That job is not done yet, and they're willing to accept the risk of even a recession to get that job done, and thinking about what that means from a longer term. So it is interesting as we've gone through the first 2 quarters of negative growth to see the number of people parsing the definition of what a recession is and what it is not. Our general sense is that the first 2 quarters will not be defined as a recession by the National Bureau of Economic Research, but we're moving that direction, Jill. I think it's just a matter of time.
Right. Well, I mean, Steve, at the end of the day, recessions are part of the business cycle, and it seems as if we have almost artificially tried to almost, stave it off, if that
Right.
makes any kind of sense. I mean, we've just been so flush with liquidity. Fed policy has almost made it impossible for that cycle to complete itself.
Yeah, and we've been through a long period, Jill, as you know, where that cycle had been lengthened, and so recessions were much less. They occurred much less often,
Right.
and they tended to be tied to crises, and so. You're right. The normal business cycle kind of goes through this. And that's one of the lessons, or one of the messages we have for our investors as we move through this is, look, this is nothing we've seen this before. It has been a long time since we've had inflation this high, back to 1982, which is when I started my investment career. So we're not arguing with the fact that this period is a little bit different than what we've seen, but the Federal Reserve can deal with this. The slowdown in the economy is not the end of the world. I'm not saying it's good for investors. And I think Chairman Powell tried to say that. We're going to have some pain to go through. But like many things, if you deal with a little bit of pain, slow down the economy, really his goal is to make sure that longer term inflation expectations continue to come down. And if we can do that now, that just keeps us from having to have a much sharper recession at some point in the future to eventually bring down that recession. I think that's a lesson that this Fed learned from the Paul Volcker Fed in the early 80s, where even Chair Volcker eased too quickly in 1980 and had to then really trigger a deep recession in 1981 and 82 to finally kill inflationary pressures. This Fed does not want to fight that kind of battle.
And they've been quite vocal about it, about not easing too fast, to your point. So then, Steve, has inflation peaked?
Well, are we talking about headline or core? Because I think it's going to be a really interesting few months as we move forward. Look, we know energy and food are highly volatile. I think those can move around a little bit. But the data that we've seen in last month's CPI, PPI, and even the PCE that came out today, where you saw headline flat to declining, but the underlying core measures were still higher on a month-over-month basis. I think that points to a potential for an interesting trend where we may even see headline decline relatively rapidly, but core inflation stays sticky. And that's going to be what the Fed is going to pay attention to. It's rents and wages. That's really where they need to go. And so we're going to be getting this mixed message around inflation, where headline may be abating relatively more quickly than what core inflation is declining.
Oh, and by the way, we have midterms coming in November. How impactful are they to the market? Do they really matter?
Well, they do. Look, it's an opportunity for the voters in the country to make an assessment as to whether or not they agree with the direction of the policies that we've undertaken over the last couple of years. There have been a lot of data points out there that have indicated that we may see some pretty significant shifts in the leadership of the House of Representatives, especially. The Senate's probably a little tougher call, just a third of senators being reelected. But you know what? That's changed a lot in the last 3 weeks. Gasoline prices are down. That's the single most, that data point has the single highest correlation to the president's approval rating. So this blue wave that we were looking at may be lessening to some degree at this point. But Jill, here's what we know. It's what, August 26th. There's a lot can change between now and November when the elections occur. So I'd be very careful about making a lot of predictions, but they will matter to the markets and the economy as we move forward.
Yeah, that time frame can almost be, things happen quick in politics, that's for sure. So with this last rally that we saw from the June lows, is that a bear market rally or potentially the start of a new bull market, or too early to make that call?
Well, I'll tell you how we approached it. We actually took the opportunity a couple of weeks ago to cut risk further. We've been steadily cutting risk in portfolios for about the last 6 months. We viewed the rally that we saw as a bear market rally and an opportunity for us to cut risk a little bit more. Look, I don't want to say that anybody's ever upset about the market rallying. That's good. We're never fully out of the market. You don't want to put yourself in that position. But our general sense is, Jill, is we still have some work to do from an economic standpoint, from an earnings standpoint, from what the Federal Reserve is going to be doing. And that ultimately we wanted to take the opportunity to reduce risk in equities a little bit further. We're now carrying a little bit higher cash position. It's nothing, like I said, we're not completely out of the market. But our view is that we're going to see some more difficult times in the economy and the markets as we move through the next 3 to 6 months.
All right, Steve, great insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Joe.